A contract account may be defined as a systematic recording of the work done under each contract. Under each contract. For a third party, under each contract for a third party, in consideration, who agrees to pay a fixed sum of money at the completion of full work or part payment after the work is completed partially and is being certified / approved by the architect. Are you there? And is being certified and approved / approved by the architect or surveyor. By the architect or surveyor. Full stop. That's right. The word contract is reserved for those jobs which require all the attention or most of it to be devoted to it. The work is done for a third party. The work is done for a third party who agrees to pay a fixed sum of money at the completion of the work. A fixed sum of money at the completion of the work. Subheading right, certification of work done. When a building is being constructed, the contractor is paid on the basis of architect certificate or engineer certificate. The architect or engineer will visit the site at regular interval and will issue a certificate stating his or her estimate of the value of the work done. Full stop. Now, under it, write a work in progress. Work in progress. The work in progress are partly finished goods. The work in progress are partly finished contract. Partly finished contract. Partly finished contract. And it can be certified or uncertified. And it can be certified or uncertified. The next subheading, allocation of overhead. Any administrative overhead expenses that are not traceable directly to individual contract sites may be split between the contract using an appropriate base. Example, managing director's salary. Managing director's salary, cost of advertising, etc. Are you there? Full stop. Subheading, profit estimation. Profit estimation. In order to estimate profit or loss on a contract, more information is needed beyond the values shown in the contract account. More information is needed beyond the value stated in the contract account. To minimize the risk of profit being overstated or losses understated, the concept of prudence is applied, and the profit is reduced according to an appropriate modifier. And it is given as apparent profit times 2/3 times cash received over work certified amount available for dividend. Format of a contract account. Before we write this, let's see the format. Are you there? Format of a contract account. In a contract account, all direct cost. In a contract account, all direct cost, such as material, wages, cost of special plant and equipment, are debited to the contract account, and also all indirect expenses based on equitable basis are also charged to the account on the debit side. Charged to the account on the debit side. On the credit side, the balance of materials at site and plant and equipment at depreciated value. You can now write this for some of them that have not written that. That's the format of the contract account. What do I have said? I'm going to throw more light on that. Okay, now let us explain what we've written down. Now, I want to see the contract account. Of course, those in estate management should be, if you've not started now, should be very much familiar when it comes to contracts and items that relate to site. Now, when it comes to contract accounts, it is a systematic recording of a job that is done for a particular contract. For instance, if you have somebody that wants to build, let's say, a road or a house, now he gets a contractor for that person to undergo or take up a certain project. Okay, now please follow me. Now, this contractor might be is a company. Let's say there's one that will know here, Rochi, which is owned by Rochas. How many of you know this company? Or you have seen it? Okay, we're the one walking the road. Now, the contractor will have to ensure, because this is a company, and when it comes to a contract, they don't just pay the money in full at once. They pay based on completion. Please follow me. For instance, if somebody wants to build a house, they don't just bring an estimate and say the house, everything that will build is 50 million, and they pay the total amount like that to the contractor. It is not done. That they pay based on what they have agreed and the completion. Now, The payment of any contract will be based on what we call the architect certificate. Now, the certificate we're talking about is not when you go to school, it is a certification. That means you are ascertaining, or the engineer at the site will come and meet the owner of the house and say, okay, Oga, we have done, from what I have observed in the project, they have done to this level. We can pay at this level. Till the engineer is certifying that the contract has undergone a certain stage. So that amount can be paid for that stage they've done. So that is why we say it is called work in progress. Work in progress means a partly finished contract. When you're not done, but the work is still continuing. That's why if you are passing through a road that they are working, they will put a signpost and say men at work, means they are still undergoing it, or work is still in progress. And that work in progress said it can be certified or uncertified. Certified relate to a situation like what I've said, when the engineer in charge or the architect is satisfied that okay, we have done like 80%, 80% of the job is done. So 80% of the job is done for the contract value. It means they cannot pay. It means 80% is certified, while 20% is uncertified. It means he has not certified that it is complete. Okay, so that is what relates to a contract. Now, also, the next thing we saw there is allocation of overhead. Now, when it comes to contract, like I said, if this is a company, they might be holding different site work at the same time. For instance, this same company might be working in Port Harcourt. This same company might be working in Enugu. This same company might also be working in Lagos at the same time. So, what do we do as at this time? Because it's the same company. What they just have to do is to get their workers working at different sites. So, when it comes to the contract account, we have the direct expenses and also the indirect. The direct is relating to all those things that concerns the work they are doing in a particular site. For instance, if they have 3 workers here and they have like 10 bags of cement or material they are bringing here. Now, these are direct, because you know that you are going to charge everything you are going to do for the people you are working for in Port Harcourt. Now, when it comes to Lagos, now Lagos might have more. Probably they have much work doing there. Let's say they have like 50 bags of cement, and they also have like 20 workers. Now, this is direct. Now, we have for Enugu, might be, let's say, just a worker and 5 bags of cement. And these are direct expenses because they are directly related to the site that company is working on. But there are some expenses that is not direct. For instance, in this company now, they will have a managing director. That managing director will have to ensure that he goes to the different sites. Moving to the different sites, then his salary is not a direct expenses. Why? Because you cannot only charge it to Port Harcourt. Because since he's on salary, he's working, he's going here to supervise, and also going here to supervise. The same way, if this company is also advertising what they are doing, the cost of advertisement, since it is the whole company, it will also be charged to all the contracts they have. So we call that overhead. These are expenses that are not directly, they are indirect expenses. Unlike this 10 bags of cement, we can ascertain that, okay, in Port Harcourt, they use 10 bags of cement. We know the amount of 10 bags. In Lagos, they use 50 bags. Or in Enugu, they use 5 bags. Or we have laborers, 3 workers that we paid. Or we have 20 workers that we paid. We have 1 worker. These are direct. You know how much you are spending on each contract. But there are expenses that are indirect that you can't tell how much was used on this because they are used for the company as a whole. So what do? They have to allocate based on the usage, a percentage of how much they have used them and charge them to each of the contract. That's what we call allocation of overhead. Okay. What's the next subhead in there? What's the next subheading I gave there? Profit estimation. Now, like I said, this is a company, and in a company, they have their shareholders. You know those who call shareholders? Who are shareholders? Those who what? Thank you very much. Those who have shares in a company, they are entitled to what we call dividend. If the company makes a profit at the end of the year, they will not pay them what dividend. Why? Because they contributed. I said something about share before in this class. Because they contributed part of their money to the establishment of that company. Now, most of these contracts, you will see where they are telling you they are building a bridge. Most of the contract, most time, is not within a year. Most of them exceeds 1 year. Most time 2 years, 3 years, they are still working on a particular contract. So this contractor, this company will not have to wait for that 3 years before they will declare profit and pay shareholders a dividend. Because by law, they're supposed to declare profit, annual profit within a year. And if there's a profit or loss, then if there's profit, then they pay shareholders their dividend. So what will they do? They'll have to estimate their profit based on the work certified and what they have received. Now, in accounting, there's what we call prudence. It means that you don't overestimate profit or underestimate losses. And what it means is that this contract account and everything that concerns it, there is more to it, or there might be expenses that they did not take into cognizance. So what they are trying to say is that if probably what they receive is, let's say, 500,000 based on what they have received, and what they have spent is 400,000, they should not just declare that they have made profit of 100,000, because there are some things that they did not take into cognizance that might occur later, and you will not go and start telling shareholders you have paid dividend for them to bring back the money. So what do? Now they brought a formula for them to actually get a certain percentage that will be reserved and share the other money to the shareholder, so that should in case afterwards, because if they walk a particular road, though there's what we call retention, and the stipulated time they gave for that road or that building to stay, that road didn't stay up to that time, they will have to pay back the money. It's just like those of you staying in the hostel. There's what we call caution fee. Abi?
Yes.
Huh?
Not only in hostels.
Both in houses, right? What does it mean?
If you damage anything in the house.
That money has gone, Abi?
Yes.
Uh-huh. So it happens here also. Most times they retain, the people giving the job retain part of the money. And if probably you tell them that this road or this house will stay 2 years or 3 years, and before it gets to that time, thing damage, that money has gone that they retain. So it becomes a loss to the company. So what they do is that they don't share all the money that they have gotten and say that total money is a profit. So they derive a formula that they will take part of that money and declare as dividend, and the remaining part they reserve it. So they came about with this. It is called apparent profit times 2/3 times the cash received, what they have received, divided by the work certified. So what it will give you is the money that is they are terming as profit that will be declared for dividend, while the remaining amount becomes reserve. Reserve is the part of the profit that is not shared. Okay, so that is all about that. So this is the contract account. Now the debit side, like we have seen, records all the items, direct expenses, and also the indirect expenses, and also plant and machinery that they are using. Debit side records them, while the credit side records. Now, if in the question they gave us work certified and also uncertified, record it there. Materials at the site, that is what is remaining. For instance, if they took to the site, materials they purchased is 10 bag. At the end of the contract, they now discovered that what they used was 8 bags. How many bags will be remaining? Huh? 2 bags. So that 2 bags is what will come here. That is what is remaining. The same thing, we have plant at site, depreciated value. Then we have materials returned to store. Materials they return back to store. Then also plants they return back to store if they are returning any plant. So now, if you add everything here and you add everything here, now there is profit if the credit side is greater than the debit side, and there is loss if here is greater than here. Now please follow me. Now when you add this and you add this up to the point before the profit, the value you will get is what we call apparent profit. That is what you will get here. When you add all this and you add all the expenses and the value here before the profit and the reserve, the value you will get when you get their difference is called the apparent profit. So we now use this formula to get this profit or loss. So this is what they will now share to the shareholders as dividend. The remaining value, which is now the difference between here to here, becomes reserve. So we add that. So the reserve carried down can be brought down here. Wages accrued can also be brought down here. Materials at site brought down here. Plant at site brought down here. So that is the contract account. And let's see a question so that we can practicalize what we have done. Amco Limited was awarded a contract for the building of an office block for local government staff union. The contract was started on January 1st, 2001. During the year, the following materials were taken to the building site. Now, the first one we have, they said materials delivered to site from supplier is 18,000. The next one, materials delivered to site from store is how much? 9,000. The third one, plants purchased on what? 2001 is what? 30,500. Then the next one, direct expenses is 4,000. Wages is how much?
1,000.
Then overhead charge to contract.
11,000.
Then they now gave us additional information. They said the following information is available on December 31st, 2001. The first one is unused materials on site amounted to 3,500, and direct expense outstanding amounted to 600. Number two, the supervising architect issued a certificate for work done amounting to 90,000, and this was paid with 10% retention money withheld. The third one, the plant and machinery has a useful life of correct it, supposed to be 16 years. See why it is important to have a first book. Just write 16 on it. Is that will pay you? Has a useful life of what? 16 years. After which it will be sold as scrap for 500 naira. The fourth one, Amco Limited takes credit for only 2/3 of the profits on work certified. You are required to prepare the what? Contract account for the period December 31st, 2001, showing the amounts to be transferred to the what? Profit or loss account. Some of you don't even need to hear. It's just that So we want to solve this question using this format. So they gave us the question. They said the name of the people is AMCO Limited. They were awarded a contract for building staff by local government staff union. So we are preparing their contract account. Now let's start from the first one. You have your text. They said materials delivered to site from supplier 18,000. Now we said every expenses should be what? Debited. So we have materials to site as materials from supplier. Is that much?
18,000.
18,000. What's the next one?
Material from store.
Materials delivered from what?
Store.
Store is how much?
9,000.
So they also carried materials from store 9,000 to the site. Remember, they can purchase and they can also bring from their store. That's why I have materials purchased. It means what they have in store is not enough. Probably they want to make use of 50 bags of cement, and what they have in store is 20. So they will also bring that one from the store to the site and also buy the remaining 30. So that's why I have material from store and purchase. We still the same thing, material from supplier. So what's the next one? Plant purchase on what? April 1st. So we also have plant and machinery, actual value, which is a cost. You put it there. So we have plant and machinery. How much is it?
30,500.
30,500. Now what's the next one?
Direct expenses.
Direct expenses is how much?
4,000.
4,000. Now please, I know while we are treating the first topic, I made mention of arrears, prepayment, and all that. Now check in the additional information. They said unused materials on site amounted to what?
3,500.
And direct expenses outstanding amounted to what?
600.
Now what do we say is outstanding? We say the same thing as unpaid, right?
Yes.
Arrears, accrued, owing. So outstanding, we say you add it to the already existing expenses. If you remember what we did there. So we are going to add the direct expenses. The direct expenses, it's how much?
4,000.
4,000, right? Now if we add the outstanding, 600. So 4,000 plus 600 gives us what? 4,600. Are you there? Okay. Now what's the next one? Wages. Wages is how much?
1,000.
Wages is the money they are paying to the laborers, those that are working, the mercy men. So we can have wages also on the debit side, 1,000. Yes. What's the next one?
Overhead.
Overhead charge to contract. Now I've explained overhead. These are indirect expenses. Now the one they are charging to the contract, they said is what? 11,000. 11,000. Okay. Now, if you check in the additional information, they said unused materials on site amounted to what? In the additional information, unused material. 3,000 what? 500. Now, what it means is that, look up, materials from supplier. Now, they bought material from the supplier and they also brought the one remaining in the store. So, after the completion of the work, the remaining one, they took it back to the store, right? That is materials remaining. So, we said we'll also bring it here. So, we have unused material. Is that much? 3,500. 500. Okay. Now the next one, we have done the outstanding. The second one there, they said the supervising architect issued what? They issued a certificate for work done amounting to 90,000. So it means that the engineer or the architect in the site viewed the work done and issued a certificate in which they paid what? 90,000. So we have, which is this? Work in progress that is certified. So we can have the architect certificate or certified. How much is it? 90,000. Now another thing we can record here is the plant at depreciated value. Now look at what they said, the third additional information. They said the plant and machinery has a useful life of what? 16 years. After which it will be sold as scrap for how much? 500. Now look up. Now, if you remember your ACC 101, how do you calculate your depreciation? How do you calculate depreciation? The formula for depreciation is cost minus scrap value over number of useful life. This is the formula. It's different from when they give you a percentage. Percentage of, I say, the plant and machinery is 10% of the cost value. But the formula is cost minus scrap value. And scrap value, what is scrap value? It is that value in which you are selling an asset when it is no longer economical to use. So now if we are using this formula now, what is the cost of plant and machinery? 30,500 minus what is the scrap value? They said they are going to sell it what? 500, right? So divided by what's the number of useful life they gave us there? 16. So we now have 35 minus 500 is what? 30,000, right? Divided by 16. What do we have? 10,000 divided by 16 is what? 1875, right? Now look up. This is the depreciation that has happened to that asset. 1875. Now, but they said we are recording plant at site depreciated value. It means we are recording the new net book value of that asset. And how do we get net book value? It is cost minus depreciation. Now, what's the cost? Cost is still 30,500 minus what is depreciation? 1875. So what will now be our new value of the asset? 35 minus 1875. What do we have? 28,625. So that is what we write here. The plant at site, that's the depreciated value. 28,625. Are you there?
Yes.
So that is that. Now, like we said, the first thing we are going to get here now, let's know if there is profit or loss. That's apparent profit. Like I told you, they don't declare all their profits as dividend. And you get the totality of this minus all you have before the profit or loss. So add here for me. Let's know here, and somebody else add this other part. Which one? This side. 1, 2, 2, 1, 2, 5. So the credit, what's this? Add this one for me. This plus this. 74,000. It is sure. Okay. Now, which of them is greater? This, right? So it means there's a profit. It means this credit side is greater than this. So help me get the actual value. 122 125 minus 74 100. What do we have? Huh? Like this?
Yes.
48025. Now, on a normal, if they are not applying the prudency principle or concept, they will declare this 48,025 as profit and share everything to the shareholders as dividend. But because they recognize that it is not everything they have captured here is what actually happened at the site, so they are reserving a particular aspect of money. So as in case in the future, the people they've done the work for comes back and complain, they can also take from part of that money. So they are now using the formula we talked about. So this becomes the apparent profit. So we are now using this formula to get the profit or loss that will be declared as dividend. So the formula, like I said, I gave you, we said is the apparent profit times 2/3 times the cash received divided by what? Work certified equals to the amount that is available. So what's the apparent profit? 0.25 times 2/3 times cash received. Now, how much was received? Did they give us the amount that was received? Now, look up. Now, check in the second additional information. They said the supervising architect issued what? Work done amounting to what? 90,000. And this was paid with a 10% retention money held. Listen, look up. Look up. What they certified that they should pay at that level is 90,000. But before, they don't pay this total amount to them. This is what they are certified that, okay, for this work they have done, I am certifying that the value of what we are going to pay is 90,000. But what they will give them, they will reduce what we call retention fee, 10%, which I asked you about your caution fee for those staying in the houses. Now that 10% is what they are telling us in the additional information. So we now have 90,000 times 10/100. What do we have? 10% of 90,000 is what? Is 9,000. Right? So it means 9,000 was retained. So if they are to pay the certified 90,000 and they are retaining 9,000, what is the amount that they receive that they pay to them? It is this certification minus what was retained. So 90,000 minus 9,000 will give us what? 81,000. So that becomes what they receive. Yes? Are you in this class? Cash received is what? 81,000 divided by the work certified is what? Certified 90,000. So the amount it will give us becomes our profit. So help me please. This times this divided by this. Did you do it or you are just calling from? Where did you do? You can add all the numerator and divide it by all the denominator. 28,815. Like this.
Yes.
Okay. So it means our profit here is 28,815. Hope you know how we got this. This is as a result of this. Now our apparent profit is adding all this and deducting this from it. Now this will give us the apparent profit, which is this. Now we apply this to get what is being shared. And also to get the cash received, it is 10%, which is the retention fee of the work that was certified. Okay. So now we'll now have a reserve. Remember, the total difference between here and here was supposed to be 48,025. But now we have a profit. So the remaining balance becomes what they are reserving, the company. So we have a reserve carried out. So help me again. Add here again and add here. And let's know the difference. Or you can still do 48025 minus this. 19,210 is what they are reserving. So we now have 122, 125. So this is the profit. Remember, the question said we should show the profit going to the profit or loss account. So this is a profit. So now let's now write down the value. Materials at site that they are going to use that is remaining 35, and also plant at site is how much? 28,625. Then we can now have our reserve. What is remaining? 19,210. 19,210. So that is the contract account. Okay, now listen. Also, for the benefit of those that are not here. Now, said the contract or contract account has to do with a recording of a work that is done for a particular job. For a particular job. Now, I made reference of, I said, for instance, a company. Can I clean this?
No.
Okay, let me just be saying. A company, I use Rochi, for instance. That's this Rocha's company. As a contract, they are contractor. I said a company might have different states or different sites they are working simultaneously. It is possible. They might be working in Port Harcourt, they might be working in Lagos doing bridge, and they might be working in Enugu, also building road simultaneously at the same time. Okay? What you just have to do is to get laborers that is working at each of the sites. So what it means when it comes to contract account, it requires that each of these sites has its own recording of what they are spending and what they are receiving. Each of the side has recording of what they are spending and what they are receiving. So contract account has to do with a recording or systematic recording of transaction involved in a contract. Okay. Now, I said when this happens, also we have what we call the direct and the indirect expenses. Now, what are direct expenses? These are expenses that can be charged to each of the sites directly, because definitely each of these sites will not have the same pattern of work. Probably in Port Harcourt, you might be building bridge. In Lagos, you are working normal road and also building bridge. In Enugu, might also be just building a house. These are different sites and the work to be done. And since they are different, it means that their direct expenses will not be the same. What do I mean by direct expenses? It means the expenses that is directly traceable. Look at me now. The expenses that is directly traceable to a particular production unit. For instance, if Port Harcourt, what they are building, they are using 50 bags of cement. Lagos, they are using 100 bags of cement. Enugu, they are using 20 bags of cement. It means the workers here, they might have, let's say, 5 workers. Here they might have 10 workers, laborers, and here they might have 3 workers. Now, these are direct costs. They are direct because what they will spend here in terms of the direct will not be the same with what they will spend here and also what they will spend here. Now, also, we also have indirect expenses. What are the indirect expenses? These are those expenses that are not directly traceable. It means they are general. For instance, I said they might have a managing director. That managing director is receiving salary, and his work is to go and supervise all this site. So they are paying him a certain amount of salary, not based on each of the sites, but it's a general amount. But at this time now, what do? So they will have to get a certain percentage so that each of these will get a percentage expenses of the managing director's salary. They will charge it to it as we call that overhead. That's what we call overhead, indirect. But these other ones are direct. Materials from supply, material from store, these are direct expenses. While the indirect, you get a particular basis of apportioning them, sharing them, so that each of the sites will also take his own fair share of expenses. Okay. Now, I said when you have also incurred expenses, payment of every contract done, they don't pay full amount of money. Let's say the contract value is 1 million. Say build a house. Want to build, say this house is 1 million. The contractee, that is the person that have the house that you want to build, will not just pay you this 1 million. They don't do that. What they do, they pay based on what we call architect certification. Now, what we mean by architect certification, or we call it engineer certification. Your engineer that is at site will look at the site and say, okay, what they have worked as according to a certain percentage, let's say 50%, 60%. So what it means is that we are going to pay 50% or 60% of the contract value, or what you people have agreed, you now pay 60%. So we call that certified. It means he has certified that, okay, 50% of the work have been done. So let's pay 50% of the money we agreed. Do you understand me? So 50% of what they agreed, the total amount of that contract, they are going to pay it, which is what we call certified. I will also have uncertified. Look at it here. Certified. This uncertified is that portion that the engineer or the architect have not certified that he has satisfactory opinion on. Okay, so we call that, and both of them give what we call work in progress because they are not done yet. Okay, now like we have seen inside this certification, they still have a retention fee. Retention fee is that amount that you don't pay fully. It's normally in percentage 10%, like what I called caution fee in the aspect of a building. Okay, so I think that is that. Then in the contract account, we said the debit side records items that the contractors are spending, and also the plant and machinery or the assets revalue. You record it at the debit side. While the credit side records their certificates and any unused material, and also the plants remaining at the site. Now, I said we have what we call prudency concept. It states that you don't overstate profit or understate loss. And what it means is that the contractors, they are recognizing that it is not everything that happens here that they may capture. There are some things that they did not capture that might happen. So what they are saying is, even if we have a profit, we are not going to declare all that amount as profit. We are going to retain some amount of money. So that should, in case later on we now discover there are some things that we did not record, we can also tackle that. So what did they do? They came out with a formula whereby they are going to declare a particular amount as profit. And that formula is what we call apparent profit times 2/3 times the cash received divided by the work certified. So that amount it will give you is the amount that will be the profit to be declared, because they must declare profit at the end of the year. Because this is a company, they have shareholders. Their shareholders that are entitled to their dividend. Okay, so like I said, the apparent profit is once you add the credit side of the contract account, you deduct the debit side from it. The value it will give you, now you apply this formula, the value it will give you is the apparent profit. Then when you apply the formula, you now get the profit or loss. Now, the value for the profit or loss, once you add again, deduct it from this, the balancing figure becomes reserve. And this reserve is not what is shared as dividend. So we have reserve carried down, reserve brought down here. and materials at site, the one remaining bring it down, and that is it.